Welcome to this explainer. Look, if you've been tracking the greater Montreal real estate market in 2026, you are probably scratching your head right now. We're getting bombarded with mixed signals. Data is flying left and right, and it's totally contradictory. The idea that Montreal real estate is just one big, cohesive monolith? Yeah, that's officially a myth. We're dealing with a fundamentally fractured landscape. So let's dive right in.
First up, we've got to talk about a massive macroeconomic headwind. The greater Montreal unemployment rate just spiked to 7.7% as of April. That is a steep climb from 6.3% back in January. We are absolutely feeling the pinch of a technical recession here. To put that into perspective, if we take out the bizarre anomaly of the pandemic, 7.7% is literally the highest unemployment level we've seen since the summer of 2016. Normally, a deteriorating labor market like this would just crush real estate values, right? People get cautious and demand drops.
But here's the wild paradox. Despite those job losses and all that economic anxiety, the average house price in Montreal is holding incredibly strong at $645,000 for 2026. Condos? They're also standing firm at around $425,000. It is still, somehow, a seller's market. Properties are spending an average of just 45 days listed and closing at 98% of the asking price. It's crazy. How on earth do we have rising unemployment and totally resilient property values at the exact same time?
To solve this mystery, here's our agenda for today's explainer. 1. The 2026 market paradox. 2. The headwinds of jobs and demographics. 3. The micro-market divergence. 4. Westmount's resilient prestige. 5. Hotspots like Verdun and Rosemont. And finally, navigating the fractured market.
All right, let's hit Section 1, the 2026 market paradox, where high unemployment meets resilient prices.
Listen to what Charles Brandt, the market analysis director at Cupereb, has to say about this. He notes that the Montreal market is absolutely feeling the effects of a deteriorating labor market and shifting demographic trends. He's confirming what we all suspect. The technical friction in the economy is real. When job security dominates the news, buyers naturally get cautious. And that psychology, it is heavily shaping the 2026 spring and summer markets.
Moving on to Section 2, Headwinds, Jobs, and Demographics, focusing on the macro story.
Let's look at the broader region. We've had this incredibly strong population growth over the last few years, right? Well, Statistics Canada data shows that's actually given way to a slight decline in major centers like Montreal. A lot of this stems directly from recent immigration-related restrictions. And it's simple math. Fewer new arrivals means a moderation in overall property demand across the census metropolitan area. Now, as that macro demand cools off, supply pressures are finally starting to ease. Across the Montreal CMA, total active listings have jumped by 16%. But, and this is a huge but, that inventory is absolutely not evenly distributed. For example, condo inventory has surged by a massive 17%, which is heavily impacting areas like Griffintown. Meanwhile, other types of properties, still incredibly scarce.
This brings us perfectly to Section 3, the micro-market divergence, practically a tale of two cities.
Seriously, look at this stark juxtaposition. Broad stats just do not tell the story anymore. In Saint-Luc, centrist data shows a distinctly cooling market, with single-family home sales plummeting by 32% between January and May of 2026 compared to last year. It's the same cooling story over in the village. But just a few boroughs away in Verdun and over in Old Montreal, the market is heating up fast. Verdun alone saw Plex sales surge by 9%. You literally cannot use an island-wide average to figure out what's happening on your specific block.
Let's look closer at this in Section 4, Westmount's resilient prestige, the disconnected micro-market.
Westmount is the ultimate example of a prestige area that just totally defies macroeconomic gravity. Based on centrist statistics, it's essentially disconnected from the broader Montreal median trends. While the rest of the city feels the weight of job losses and population dips, Westmount marches to the beat of its own drum. It is a highly selective, deeply resilient pocket. So why the disconnect? In a word, scarcity. Structural scarcity, to be exact. Westmount is an independent city of about 20,000 residents right in the middle of the island, and its housing stock is basically fixed. There is almost no room for major new construction. When you combine that physical limitation with a wealthy buyer profile and inherently low market liquidity, it creates a bubble. It is completely insulated from typical CMA averages.
Because of that scarcity, prices here remain, frankly, astronomical.
Down in lower Westmount, think between Sherbrooke and the Boulevard, a typical 3 to 5 bedroom home on a modest lot will run you between $2.2 million and $4.5 million. But if you look above the Boulevard in upper Westmount, prices jump from $4.5 million up to $8 million and often push way past the $10 million mark for heritage manors. This unique micro-market demands extreme patience from buyers and realistic, fair pricing from sellers.
Next is Section 5, hotspots like Verdun and Rosemont, where demand is massively outstripping supply.
While Westmount relies on prestige, other neighborhoods are seeing intense, cutthroat buyer competition. Take Rosemont La Petite-Patrie. It's a huge draw for families and young professionals, and it is a rock-solid seller's market right now. Sales are up 8% year over year, pushing the median price to a hefty $822,500. It doesn't matter what the broader economy is doing, the lifestyle and community feel here just keep buyer demand insanely high.
And then there's Verdun. The multifamily market here is absolutely on fire, with heavy, sustained investor action. Plex prices in Verdun have hit $941,000. That is a 9% jump compared to the rest of Quebec. Investors are aggressively targeting this area. It just goes to show how shifting buyer preferences for specific asset classes can completely override general market sluggishness.
Finally, let's wrap up with Section 6, Navigating the Fractured Market, your 2026 playbook.
Knowing there's no single monolithic market, how do we play the rest of 2026? Well, experts are forecasting a moderate 3 to 5% overall price increase. This is anchored by three main drivers. First, mortgage rates are stabilizing around 4 to 5%, giving buyers some much-needed predictability. Second, we still have incredibly limited supply because of a lack of new construction. And third, sustained baseline demand from new household formations is putting a firm floor under the market.
But if there's one golden rule to take away from this explainer, it's the micro-location rule. Because this market is so fractured, your exact micro-location matters more than ever. Being a block closer to transit, a great park, or the right school zone can swing a property's value by 10 to 20%. Seriously, even between two houses on the exact same street. You can look at the broad neighborhood stats to start, but to win in 2026, your analysis has to be hyperlocal.
So, taking all this diverging data into account, the macro job losses, the wild demand in Verdun, the condo glut in Griffintown, the cooling in Saint-Luc, and those extreme micro-location variances, you really have to ask yourself a critical question before making your next move. In a market this fractured, are you buying the city or are you just buying the street?